Hello, I'm Gary Bakke. Today I want to talk a little bit about the process of valuing a closely held business. There are several circumstances where you may need to know the value of your business. Number one is if you're considering a purchase or a sale, obviously value is of primary concern. Estate planning raises the need to know what a business is worth. There may be legal conflicts involving the value of the business or its earnings. Certainly, if you have an estate tax problem or in a probate situation, you have to know the value of your business. You might be considering taking in a new partner and giving or selling some equity interest in the business. Obviously, if you're in a divorce situation, you have to know the value of your assets, and that includes the value of your business. Or maybe you just want to know, maybe you're just curious. The first thing that a business appraiser is going to consider is, what are we valuing? Are we valuing the entire business? Or are we valuing your stock in that business? Or are we valuing a majority interest but not 100% of the business? Or are we valuing a minority interest in that business? The next thing that an appraiser is going to have to decide is, what is the definition of value? Traditionally, we're talking about something called fair market value. Fair market value is generally defined as the price at which a property would sell between a willing buyer and a willing seller, with both of them having knowledge of all the relevant facts and with neither one being under any compulsion to buy or sell. There are other situations where the value is defined as fair value. That sounds a lot like fair market value, but it can be different. We normally encounter fair value appraisals when there's some statutory reason, dissenters' rights and that sort of thing. Fair value is similar to fair market value, but generally fair market value will discount for minority interests or lack of marketability and similar considerations. Fair value generally does not provide a discount for those items. There's also something that accountants and CPAs refer to as investment value. That may be the test that your appraiser is going to be using. One thing to keep in mind, and that is that value is all about the future. The future is unknowable, so the appraiser is going to be scouring the past for hints about the future. They're going to be looking at the history of your assets, your income, your expenses, profits, and the markets for your company. It's going to look at the history of other similar companies in the same industry. It's going to look at the economic history of the nation, the region, and of your particular industry. The key thing to keep in mind is that value is based on what someone else is willing to pay for your business, and that hypothetical buyer is not going to pay for past profits. They're buying future performance. There are lots of formulas or rules of thumb that apply in various industries, but keep in mind that the valuation process depends on the professional expertise and judgment of the appraiser. There's no shortage of examples of companies with a highly profitable past that lost value quickly. Consider Enron, General Motors, Hewlett-Packard, or Circuit City. Remember them? They're out of business. On the other side of the coin, there are companies that have large value, enormous value, that arose out of a past with no earnings history at all. Consider the current market value for Google or Facebook, examples of companies that did not have an earnings history but have enormous value as we speak. All appraisal techniques can generally be broken down into three broad categories called methodologies. The first is referred to as the cost or asset approach. In that situation, the appraiser is going to take a look at what it would cost to purchase or to replace the assets of this business. The second broad approach is called the income approach. There are several different techniques embedded in this broad category, but all rely on the answer to one basic question. What is today's value of the future economic performance of this company? For this part of the analysis, the appraiser will want at least 3 to 5 years of financial statements and will probably make several adjustments to your historical financial records in a process that's called normalization. The normalization process will recast the business income and expenses as it might have been with a hypothetical investor. The owner's salary may be adjusted up or down to an industry norm. The rent that's paid to a facility or warehouse owned by you as the owner might be adjusted to market rents. Travel or entertainment expenses will be carefully scrutinized and normalized. Company vehicles will be looked at to determine whether they're really necessary for the business of the company, etc. After this normalization process, the appraiser will have some financial information that is then comparable to other companies in the industry and can proceed to do his analysis. The third broad category of approaches is called the market approach. The question here is, what have shares of your company sold for in the recent past? And if there are no such transactions, what have similar companies sold for in the recent past? And if the appraiser cannot identify other similar companies that have been bought or sold, the appraiser may look at the stock market to see whether or not there are similar companies that are publicly traded. And if so, they will analyze the stock price of those companies in the same industry. It's terribly important to understand that expertise, not formulas, is what drives a valid appraisal. The real expertise comes in analyzing the company's financial history, identifying comparable companies, using appropriate interest or discount rates, and appropriately adjusting for future risk. That's an expert's job. Although lawyers do not have the expertise to value your business, we do know the appropriate appraisers, and we can help you select an appraiser and help you work through the appraisal process when it becomes necessary.